Question 1. An individual applied for a life insurance policy and paid the initial premium. The insurer issued a conditional receipt. If the applicant dies before the policy is issued, which of the following statements is true? A. The policy will automatically be issued, and the death benefit will be paid. B. The insurer will return the premium, as coverage did not commence. C. Coverage may be effective as of the date of application or medical exam, provided the applicant was insurable. D. The beneficiary will receive the premium paid plus interest. Answer: C. Coverage may be effective as of the date of application or medical exam, provided the applicant was insurable. A conditional receipt provides coverage that is effective as of the date of application or the date of the medical exam, whichever is later, provided the applicant would have been insurable according to the insurer's underwriting rules. This means if the applicant dies before the policy is formally issued, the death benefit would be paid as long as they met the underwriting criteria. The core concept here is that a conditional receipt offers interim coverage, protecting the applicant during the underwriting process, but only if they were ultimately a standard risk. Remember, the key condition is insurability at the time of application. Question 2. A life insurance policy includes a provision that states if the insured commits suicide within a specified period from the policy's issue date, the insurer's liability is limited to a refund of premiums paid. What is the maximum suicide exclusion period allowed under Iowa law? A. 6 months. B. 1 year. C. 2 years. D. 3 years. Answer: C. 2 years. Under Iowa law, a life insurance policy's suicide exclusion clause cannot exceed 2 years from the policy's issue date. This means if the insured commits suicide within this 2-year period, the insurer is only obligated to return the premiums paid, not the full death benefit. This provision is designed to prevent individuals from purchasing life insurance with the intent of committing suicide, while still offering coverage after a reasonable period has passed. After the 2-year period, the suicide clause typically expires, and the death benefit would be paid regardless of the cause of death. Question 3. All of the following are characteristics of an adjustable life policy, except A. It combines features of both term and whole life insurance. B. The policy owner can change the policy period and premium payments. C. It automatically increases the death benefit annually by the Consumer Price Index. D. The cash value can be used to pay premiums if the policy owner chooses. Answer: C. It automatically increases the death benefit annually by the Consumer Price Index. An adjustable life policy allows the policy owner to adjust the policy period, term or whole life, face amount, and premium payments to meet changing needs. While it combines features of term and whole life, and cash value can be used, it does not automatically increase the death benefit by the Consumer Price Index. That feature is characteristic of a cost of living rider, not an inherent feature of adjustable life itself. Understanding the flexibility of adjustable life is key. It's designed to adapt to the policy owner's circumstances. Question 4. An Iowa life insurance producer submits an application for a new policy and intentionally misrepresents the financial strength of a competing insurer to persuade the applicant to purchase the new policy. This is an example of which unfair trade practice? A. Twisting. B. Rebating. C. Defamation. D. Coercion. Answer: C. Defamation. Defamation is an unfair trade practice involving making oral or written statements that are false or maliciously critical of the financial condition of an insurer or an individual and are calculated to injure any person engaged in the insurance business. In this scenario, the producer is misrepresenting the financial strength of a competing insurer, which falls directly under the definition of defamation. Understanding the specific definitions of unfair trade practices is crucial for licensing exams. Remember, defamation focuses on damaging reputation through false statements. Question 5. In Iowa, if a policy owner replaces an existing life insurance policy, the replacing insurer must provide the applicant with a notice regarding replacement. What is the primary purpose of this notice? A. To allow the replacing insurer to charge a higher commission. B. To inform the applicant of potential disadvantages of replacement. C. To accelerate the underwriting process for the new policy. D. To waive the free look period for the new policy. Answer: B. To inform the applicant of potential disadvantages of replacement. The primary purpose of the notice regarding replacement is to inform the applicant of the potential disadvantages of replacing an existing life insurance policy. Replacing a policy can lead to new incontestability periods, new suicide clauses, potential surrender charges on the old policy, and higher premiums due to age or health changes. This notice ensures that consumers make informed decisions by highlighting these potential pitfalls, protecting them from detrimental replacements. Always remember that consumer protection is a core reason for such regulatory requirements. Question 6. A life insurance policy is issued with a standard grace period. The insured dies on the 20th day of the grace period without having paid the premium due. What will the insurer do? A. The policy will lapse, and no benefits will be paid. B. The insurer will pay the full death benefit. C. The insurer will pay the death benefit minus the unpaid premium. D. The insurer will return all premiums paid to the beneficiary. Answer: C. The insurer will pay the death benefit minus the unpaid premium. The grace period is a provision that allows the policy owner an additional period, typically 30 or 31 days in Iowa for life policies, after the premium due date to pay the premium without the policy lapsing. If the insured dies during this grace period, the policy is still considered in force, and the death benefit will be paid, but any unpaid premium will be deducted from the death benefit. This ensures that the policy remains active and the beneficiary is protected, even if there's a slight delay in premium payment. Question 7. All of the following are true regarding the Medical Information Bureau, MIB, except A. It is a non-profit organization that maintains medical information on applicants. B. Its primary purpose is to help insurers share adverse medical information. C. It helps to prevent fraud and misrepresentation by applicants. D. Insurers are required to disclose to applicants that MIB information may be requested. Answer: B. Its primary purpose is to help insurers share adverse medical information. The Medical Information Bureau, MIB, is a non-profit organization that helps insurers detect and prevent fraud, omissions, or misrepresentations by applicants. Its primary purpose is not to share adverse medical information directly, but rather to serve as an alert system, allowing insurers to cross-reference reported medical conditions or other information with other insurers' records. This helps insurers perform more thorough underwriting and assess risk accurately, while protecting applicant privacy by only providing codes, not detailed medical reports. Question 8. Under Iowa law, what is the required free look period for a new individual life insurance policy? A. 5 days. B. 10 days. C. 15 days. D. 20 days. Answer: B. 10 days. In Iowa, like most states, an individual life insurance policy must include a free look provision, allowing the policy owner to return the policy for a full refund of premiums paid within 10 days of receiving it. This period gives the policy owner time to review the policy and decide if it meets their needs without financial penalty. This consumer protection ensures that buyers are not pressured into purchasing a policy they don't fully understand or want. Question 9. Which settlement option provides a beneficiary with a guaranteed income for a specific period, after which no further payments are made? A. Interest only. B. Life income. C. Fixed period. D. Fixed amount. Answer: C. Fixed period. The fixed period settlement option pays the death benefit in equal installments over a specified period of time. Once the chosen period ends, all payments cease, regardless of whether the beneficiary is still alive. This option guarantees payments for a set duration, which is suitable for beneficiaries who need income for a defined number of years, like while a child is in college. Question 10. A policy owner in Iowa requests a loan from the cash value of their whole life policy. All of the following are true regarding policy loans, except A. The loan cannot exceed the policy's guaranteed cash value. B. The policy owner is required to repay the loan with interest. C. If the insured dies with an outstanding loan, the death benefit will be reduced by the loan amount. D. Policy loans are considered taxable income to the policy owner. Answer: D. Policy loans are considered taxable income to the policy owner. Policy loans are generally not considered taxable income to the policy owner because they are treated as an advance against the policy's cash value, not a distribution. The loan must be repaid with interest, and if the insured dies with an outstanding loan, the loan amount is deducted from the death benefit paid to the beneficiary. The loan cannot exceed the available cash value. It's important to remember that as long as the policy is in force, loans typically do not create a taxable event for the policy owner. Question 11. An insured purchased a variable life insurance policy. Which of the following statements about this policy is true? A. The cash value is guaranteed and invested in the insurer's general account. B. The death benefit is fixed and does not fluctuate. C. The policy owner bears the investment risk. D. Premiums are fixed and cannot be changed. Answer: C. The policy owner bears the investment risk. With a variable life insurance policy, the cash value is invested in a separate account, and the policy owner directs the investment choices and bears the investment risk. This means the cash value can fluctuate based on the performance of the underlying investments, and there is no guaranteed cash value. While the death benefit has a guaranteed minimum, it can also fluctuate upward. Variable policies require securities licenses because of the investment risk transferred to the policy owner. Question 12. Which type of life insurance policy is characterized by a level premium for the life of the insured and guaranteed cash value growth, but requires premiums to be paid for only a limited period, such as 20 years or until age 65? A. Whole life. B. Limited pay whole life. C. Term life. D. Universal life. Answer: B. Limited pay whole life. Limited pay whole life is a type of whole life insurance where premiums are paid for a specific, predetermined period, example 20 years or until age 65, but the coverage extends for the entire life of the insured. Once the premium payment period ends, no further premiums are due, but the policy remains in force and continues to accumulate cash value until the insured's death. This differs from traditional whole life, where premiums are typically paid for life, and term life, which only covers a specific period. Question 13. An Iowa resident obtained a life insurance policy, but the application contained a material misrepresentation that was not discovered by the insurer until after the policy had been in force for 3 years. Under the incontestability clause, what action can the insurer take? A. The insurer can deny the claim and refund premiums. B. The insurer can void the policy due to fraud. C. The insurer must pay the death benefit, as the incontestability period has passed. D. The insurer can reduce the death benefit proportionally. Answer: C. The insurer must pay the death benefit, as the incontestability period has passed. The incontestability clause in a life insurance policy prevents the insurer from denying a claim based on statements made in the application after the policy has been in force for a specific period, typically 2 years from the issue date. Since the misrepresentation was discovered after 3 years, the incontestability period has passed, and the insurer cannot deny the claim or void the policy, even if the misrepresentation was material. This clause protects policy owners from having their coverage challenged years after it was issued. Question 14. What is the primary purpose of the entire contract provision in an Iowa life insurance policy? A. To allow the insurer to make changes to the policy terms at any time. B. To ensure that the policy and a copy of the application constitute the complete agreement. C. To permit the policy owner to assign policy ownership to another party. D. To outline the various settlement options available to beneficiaries. Answer: B. To ensure that the policy and a copy of the application constitute the complete agreement. The entire contract provision states that the life insurance policy itself, along with a copy of the application, constitutes the entire agreement between the policy owner and the insurer. This provision prevents either party from referring to outside documents or agreements to interpret or challenge the policy. Its core purpose is to protect the policy owner by ensuring that all terms and conditions are contained within the policy document, preventing the insurer from later citing unstated rules or representations. Question 15. A producer in Iowa has been found guilty of rebating. Which of the following describes the illegal act of rebating? A. Offering a prospective client an inducement not specified in the policy to buy insurance. B. Replacing an existing policy with a new one without proper disclosure. C. Making false statements about the financial condition of an insurer. D. Charging different premiums for individuals in the same risk class. Answer: A. Offering a prospective client an inducement not specified in the policy to buy insurance. Rebating is the illegal practice of offering an applicant an inducement, such as a portion of the commission, a special favor, or an item of value not specified in the policy, to persuade them to purchase insurance. This practice is prohibited because it can lead to unfair discrimination among policyholders and undermine the integrity of the insurance market. The key takeaway is that any kickback or freebie not part of the policy itself, offered to induce a sale, is generally considered rebating and is illegal. Question 16. Which of the following statements is true regarding a fixed annuity? A. Its payments fluctuate based on the performance of a separate account. B. It offers a guaranteed minimum interest rate and guaranteed level payments. C. It requires a securities license to sell. D. The annuitant bears the investment risk. Answer: B. It offers a guaranteed minimum interest rate and guaranteed level payments. A fixed annuity offers a guaranteed minimum interest rate during the accumulation phase and provides a guaranteed, level stream of income payments during the annuitization phase. The insurer bears the investment risk because they guarantee these returns, and therefore, a securities license is not required to sell fixed annuities. This stands in contrast to variable annuities, where payments fluctuate, the annuitant bears the investment risk, and a securities license is required. Question 17. An insured has a life insurance policy with a guaranteed insurability rider. This rider allows the insured to: A. Purchase additional coverage without evidence of insurability at specified future dates. B. Receive a portion of the death benefit if diagnosed with a terminal illness. C. Waive premiums if they become totally disabled. D. Increase their death benefit based on inflation. Answer: A. Purchase additional coverage without evidence of insurability at specified future dates. The guaranteed insurability rider allows the policy owner to purchase additional amounts of life insurance at predetermined ages or on specific life events, like marriage or birth of a child, without having to prove their insurability. This is extremely valuable because it ensures that an individual can increase their coverage as their needs grow, even if their health deteriorates. It essentially locks in their ability to get more coverage later, regardless of their health status. Question 18. What is the primary purpose of the Iowa Life and Health Insurance Guaranty Association? A. To regulate insurance companies operating in Iowa. B. To protect policy owners, insureds, and beneficiaries in case an insurer becomes insolvent. C. To promote competition among insurance companies. D. To provide legal advice to consumers regarding insurance claims. Answer: B. To protect policy owners, insureds, and beneficiaries in case an insurer becomes insolvent. The Iowa Life and Health Insurance Guaranty Association is a state-created entity designed to protect policy owners, insureds, and beneficiaries in the event that a member insurance company becomes insolvent, financially unable to meet its obligations. The association pays claims, up to certain limits, that would have been covered by the insolvent insurer. It acts as a safety net, ensuring that even if an insurance company fails, policyholders don't lose all their benefits. Question 19. If an applicant for life insurance in Iowa misstates their age, and this misstatement is discovered after the policy has been issued, what is the most common action the insurer will take? A. Void the policy and return the premiums paid. B. Adjust the death benefit to what the premium would have purchased at the correct age. C. Increase the future premiums to reflect the correct age. D. Deny the claim if the insured dies. Answer: B. Adjust the death benefit to what the premium would have purchased at the correct age. The misstatement of age or sex provision in a life insurance policy states that if the insured's age or sex is misstated, the insurer will adjust the death benefit to the amount that the premium paid would have purchased at the correct age or sex. The policy itself is not voided, nor are premiums adjusted, as this ensures the policy remains in force while correcting for the initial misstatement. This provision maintains the equitable relationship between premiums paid and benefits received. Question 20. Which of the following policy riders would provide an early payment of a portion of the death benefit if the insured is diagnosed with a terminal illness and has a life expectancy of 24 months or less? A. Waiver of premium rider. B. Accidental death benefit rider. C. Accelerated death benefit rider. D. Guaranteed insurability rider. Answer: C. Accelerated death benefit rider. The accelerated death benefit rider allows an insured who is diagnosed with a terminal illness, typically with a life expectancy of 24 months or less, to receive a portion of their policy's death benefit while still alive. This payout can be used for medical expenses, hospice care, or to improve quality of life during their final months. It accelerates the payout of the death benefit, providing financial relief when it's most needed. Question 21. A qualified retirement plan purchased with pre-tax dollars will result in which of the following upon distribution? A. All distributions are tax-free. B. Only the earnings portion is taxable. C. All distributions, including the original contributions, are taxable. D. Distributions are taxed as capital gains. Answer: C. All distributions, including the original contributions, are taxable. When a qualified retirement plan, like a 401k or traditional IRA, is funded with pre-tax dollars, the contributions themselves are not taxed initially, and the earnings grow tax-deferred. Therefore, upon distribution during retirement, both the original contributions and any accumulated earnings are considered taxable income. This is because the individual has not yet paid taxes on those funds. Question 22. Which of the following is true regarding controlled business for an Iowa life insurance producer? A. It refers to insurance sold to family members only. B. There is no limit on the amount of controlled business a producer can write. C. A producer may not write more than 50% of their total commissions from controlled business within a 12-month period. D. It is generally encouraged by the Department of Insurance. Answer: C. A producer may not write more than 50% of their total commissions from controlled business within a 12-month period. Controlled business refers to insurance sold by a producer to themselves, their family members, or to their employer or employees. Iowa law, like many states, places limits on the amount of controlled business a producer can write to ensure that the producer is primarily engaged in serving the public rather than just obtaining commissions for their own or their close associates' insurance needs. Specifically, a producer's commissions from controlled business cannot exceed 50% of their total commissions within a 12-month period. Question 23. An individual applied for a life insurance policy and was classified as a substandard risk. Which of the following factors would not typically lead to a substandard risk classification? A. Hazardous occupation. B. Adverse health condition. C. Avocation involving extreme sports. D. Living in a geographic area with low crime rates. Answer: D. Living in a geographic area with low crime rates. A substandard risk classification is assigned to individuals who present a higher than average risk to the insurer due to various factors. Hazardous occupations, like stunt performer, adverse health conditions, like a history of heart disease, and avocations involving extreme sports, like skydiving, all increase the likelihood of a claim and thus lead to a substandard rating. However, living in a geographic area with low crime rates would generally be considered a positive factor for risk, not one that would lead to a substandard classification. Question 24. A policy owner has a universal life policy and decides to skip a premium payment. Which of the following statements is true regarding the policy's status? A. The policy will immediately lapse due to non-payment. B. The cash value will be used to cover the premium, keeping the policy in force. C. The policy will enter a grace period, after which it will lapse. D. The death benefit will be automatically reduced. Answer: B. The cash value will be used to cover the premium, keeping the policy in force. Universal life insurance policies are known for their flexibility regarding premium payments. If a policy owner skips a premium payment, the policy's cash value is used to cover the cost of insurance and expenses, keeping the policy in force as long as there is sufficient cash value. This feature allows policy owners to adjust payments to their financial situation without immediately lapsing the policy, although consistent underpayment can eventually deplete the cash value. Question 25. Which of the following best describes the per capita designation for beneficiaries? A. The death benefit is paid to the surviving members of a class, equally. B. The death benefit is paid to the descendants of a deceased beneficiary, by representation. C. The death benefit is divided among primary and contingent beneficiaries based on age. D. The death benefit is paid to the first beneficiary listed on the policy only. Answer: A. The death benefit is paid to the surviving members of a class, equally. When beneficiaries are designated per capita, the death benefit is divided equally among the named living beneficiaries in that class. If one of the named beneficiaries predeceases the insured, their share is redistributed equally among the remaining living beneficiaries in that class. This means the money is distributed by the head, with only the surviving named individuals receiving a share, unlike per stirpes, where a deceased beneficiary's share might pass to their heirs.